Guys, we are back with another episode of How to Invest in Commercial Real Estate.
What's up?
We vacationed last weekend together, went down to Grand Cayman. It was awesome.
Yeah, great time.
Rejuvenated. We feel great. We're ready to attack the deals we got going on. Braden, we are launching a new deal, I believe, next Monday. Tell everybody what we're going to be launching so they can get on and find out about it.
Yeah, so actually, if you're watching this, it's too late. It already launched out. It launched out earlier this morning, so you can't get on the list. We had to have a pre-existing relationship before it launched, so it's too late. But there's another one launching soon. So if you haven't signed up, make sure to go to our website and hit join our investor list. It's super easy. Name, email address. You can give us your phone number if you want to. You don't have to. And then boom, you're on the investor list and you get access to all these opportunities. But, right, if you were on the investor list, because we talk about it every week shamelessly, then you got this new opportunity. And we have done a ton of stuff in Owasso. The first one is finishing up construction. It was a ground lease to Salad & Go and a 5 multi-tenant. There's 5 tenants in a multi-tenant strip center. And then we are breaking ground on another one this week. We're finishing out the staking. They're going to be scraping dirt the rest of this week. And that's at the hard corner of 96 and Garnett and Owasso. And that's a Taco Casa ground lease and a Pickleman's build to suit. And directly south of that, we're still going. We have so many LOIs. So we are using the shop company. I think they're based in Oklahoma City.
Yep.
To do the leasing for us. And we probably have 10 or 15 LOIs. We've got the rest of the land going down Garnett and contract. So right now we're just figuring out which tenants fit best together, space planning, and we're moving on down, right? So this opportunity is an $800,000 equity raise. We're expecting a 24.5 IRR and a 1.39 equity multiple in 18 months. And we are expecting a ground lease of about $100,000, give or take, in ground rent, and then a 2-tenant, multi-tenant strip center. We'll start construction on that, before the end of the year, probably here in 60 days. And we're going to close on this deal beginning of September, I think September 4th.
And just to orientate people, when is it launching? What day? August what?
It is launching today, which is August 14th. 14th.
Okay.
Yep. And it is closing September 4th. So 1, 2, 3 weeks from the time. But if you're watching this now and there's still room, it is an $800,000 equity raise. The last raise we did was $1.4 million for a pre-lease learning experience, and it was gone in 48 hours. Yeah. So if there's room left, commit now.
All right. So speaking of the Grand Prairie learning experience, when is that closing? Because investors have been wiring in the money. All the documents are signed. We're ready to go.
Yep. That is closing tomorrow, August 15th. And again, that is a pre-leased 10,000 square foot learning experience that we're doing in Grand Prairie, Texas. It is an awesome site. It is this raw piece of land surrounded by 1,000 apartment units and a ton of little townhomes and zero lot line communities. I drove it a few weeks ago, last time I was in Dallas. So super excited about that site. This is the first of many learning experiences. We're going to do We're going to do several more. I'm not going to try to quote them now. But anyway, that is closing tomorrow. We're super excited about that deal. Ascend Construction is building that one for us. Excited about that. This is our 3rd project with Ascend. So we're starting to use some repeat contractors, Ascend and Wyatt. So we're starting to build up some relationships there.
So if you're an investor and you listen to the podcast and you are located in Tulsa or Owasso or surrounding areas, go up and see what we've got going on at 96th and Garnett. If you're in Dallas or Fort Worth, we have Burleson, we have Marine Creek, we have Princeton, we have now Grand Prairie. So there's a lot of opportunity if you're local to those areas to go by and take a look at the dirt yourself before you make a decision to invest, or if you just want to see what we've got going on.
Yeah, get more comfortable, if you will.
All right, so today's topic. Are we ready or not?
We're ready.
Okay. The big thing we're going to really hit on, because we have a lot of requests, is your biggest expense, and that is the taxes you pay to both state, local, and federal governments. So we just thought we'd kind of recap some of the tax issues that we run into with commercial real estate. First things first is our investors have been a little frustrated this year because we took a little while to get the K-1s out. And those listening are like, damn right, that took a little while.
Yeah.
We had a little bit of an issue. Some, I would say, was our fault, and some was our accountant's workload. And so we have not, it took us a lot longer than March 15th or April 15th or even July 15th to get some of these out. So when you invest with us, you will get a K-1 at the end of the year. It is challenging with as many entities as we have to get you those K-1s in time for you to file your taxes by April 15th, which is the deadline. Many of our investors just plan on filing extensions, but there are some that own businesses and they're trying to adjust or gauge what their tax bill is going to be. So it's very frustrating to them when we don't get those K-1s out in time. And so we will apologize, but we are working really hard to get an accountant hired and working with our tax accountant. We may have to split it up next year, get a couple accountants to where we're committed to getting those K-1s out sooner.
I think the biggest thing, right, just so we can all wrap our head around it, it's not just one entity, one investment, one check, right? There may be 30 investors, 30 K-1s, and then that one deal may have 8 entities. Mm-hmm. So there's a little bit of heavy lifting there, but specifically because we know how complicated it has been this year, and we're continuing to buy deals, we're avidly looking for a new accountant. We'll have them onboarded soon, and that'll be just in time for the upcoming tax prep and tax season for next year.
Yeah, having an accountant should enable us to get the information assembled and given to our outside accountant in a much more efficient manner.
I might as well shamelessly plug that we have not a huge following, but we're gaining a following. And so if you're out there listening and you know someone that is looking for an accounting position that's in our area that has some experience in real estate, hit us up. We haven't made a final decision. We're kind of interviewing right now and looking for an accountant to help us really grow the business. So we got the K-1s aside. Brian, let's talk about what investors pay in taxes and then how real estate compares to other investments, compares to their personal income.
Okay. I'd say to start with, we should go through a few different types of investments. And then at the end, maybe we show how that how that relates to, or how real estate compares to those investments.
Yeah, so the different taxes, and when you're investing in real estate, there's several different taxes. You may have short and long-term capital gains, right? So
in real estate, you're saying, or
in real estate,
yeah,
we're investing. I think those two terms apply to investing of pretty much any kind.
Yeah.
right.
Okay, but the one people are familiar with is their personal income, ordinary income taxes. So that's going to be any income you make on your day job or on income on investments or any business ideas or ventures you do where you make income in the year that you put in the effort or invested the money.
Right.
And so if it's within 12 months or if it's a day job, that's ordinary income.
Yeah. And ordinary income is taxed about just as high as any tax, right?
It's the highest, yep.
And everybody knows that it varies with how much income you make, but the highest rate is 37%. So that's, and maybe higher, that's significant.
So a question for people listening is, when he says the highest rate is 37%, if I make $1 million in ordinary income from my job, am I paying $370,000 in taxes, federal?
Yes.
No, you're not.
You're not?
It's a graduated scale.
It's graduated, but
So you're paying it as you step up.
That's the problem that people have when they're evaluating taxes.
It's
a schedule, right? So the first 10,000 or 20,000 you pay a small amount, and then on the next 50,000 you pay a higher amount, and so you're not paying 37% on $1 million. You may be paying 37% on all income over the highest tax bracket.
Yeah. Right.
So I encourage people, if you're not familiar, most people are not.
Well, most people aren't filing their own taxes, and this is why we all get CPAs, right?
Yeah, is look up the federal income tax schedule just so you understand, okay, if I make a little bit more money in ordinary income, this is what happens. This is how much I'm going to pay. This may step me into a higher tax bracket. I just think most people, with their biggest expense being taxes, they're totally unfamiliar with how taxes work, what the rate is, how the scale graduates up over time. Mm-hmm. And I think you just need to educate yourself so you understand fully the biggest bill you have in a given year.
Yeah. But at some point, once you get over whatever that rate is, when it goes to 37%, every dollar you're adding to it at that point is taxed at 37%.
That's right.
And then of course you've got state, well, not every state, but there's state tax to pay as well, right? In Oklahoma, the highest rate is what, 4.75%. So you're over 40% on those last dollars if you're in the highest tax bracket.
Yeah, that's a heavy burden. And then you've got, of course, Social Security, Medicare, Medicaid. That only applies to income, maybe 100, 150,000, but it still adds to the overall burden. You could be pushing 50% all in, if you're a really, really high earner.
Yeah. So then I think the next thing we could talk about is long-term capital gains and dividends, right?
Okay.
Because
Okay.
typically those are, again, it's a graduating scale. The top rate is 20% on long-term capital gains and dividends.
Is there, and you may not know the answer to this, but I believe that if you're in a lower income tax bracket, the first, you can maybe pay 0%,
There's 0%.
On capital
range.
gains up to a certain amount.
There definitely is a range where you're not paying any taxes.
Okay, and so then I would suggest people get familiar with that, because 0 is the best kind of tax you can pay.
Yeah.
And so if you're not earning any long-term capital gains money, and you're, let's say, just an average wage earner, you should put a lot of effort into getting some capital gain income that's going to be taxed at 0 or very low percent.
And it
That's free money.
It may only be $10,000 below. I don't know what the number is, but I mean, I'd love to make $10,000 tax free.
Yeah, that's right. Every dollar you save in taxes is a dollar you're putting in your pocket. And most people just don't spend. They'll spend a lot of money trying to save 30 cents on, a pound on chicken that they're buying at the store, but they're not spending any time trying to save $10,000 on their tax bill a year.
This is why most people's personal home ends up being the best investment in their life. The average person is because they're not paying tax on that. Because I think they just moved it from 2 to 3 years. I think it's 3 years now. That if you live in your primary home for 3 years, you don't have to pay taxes on the gains.
Oh, is that right?
Yep.
Yeah.
I didn't know that.
And
I like
so
that.
that's a huge benefit.
massive
If you
benefit.
moved every year and were able to sell and make a decent amount of money, that's a huge amount that you can earn tax free.
But
That's
for real
that
estate,
pertains to every income category.
yeah, it's just got. I believe so. I mean, I'm not too high up in the income category. Thank God for depreciation.
Let's preface all
you know.
this discussion as consult your tax professional for
definitely.
sure.
But here's the problem with most people in their tax professional, because we're talking about that, right? They send a bunch of shit to their accountant. The accountant sends them a bunch of shit back. It's typically signed in one of the exchanges, and then there's a net number of I owe this or I'm doing that.
Yeah, and you don't really know what's going on.
We're here to arm you with more questions than maybe you had before, or prompt you to say, that's a good point. I should ask somebody about this. You want to bring these questions to your CPA or whoever is doing your taxes. You want to ask, hey, why is this tax so much? Are you sure? Shouldn't this be treated as long term? I mean, you'll get an education. You may have to pay for a little bit of it, but I'm sure they're probably just charging you per form.
Yeah,
which
not
is
a
how they
knock on
typically do.
CPAs, but I mean, they're busy. They don't have time to look at every single one of them and say, hey, if you did this, 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 and this, and this, and
And they
it's
don't
more
know
tax
all
advantage.
your situation.
Yeah, they don't know the whole situation.
They're not going to do your job for you.
Right.
I would say the best available advice I can give you on taxes is to read, is to get, there are books out there, how to save money on taxes, why real estate's a good investment for taxes, how to reduce your tax bill, how to use, how to start a side hustle to reduce your taxes. There are so many ways to reduce your taxes, to take already expenses you already have and you're already paying taxes and use those as deductions to reduce your tax bill. But most people, like you say, they're just handing it over to their accountant, getting it back. What do I owe? Okay, I'm going to send that in. And that's the extent of it.
So back to capital gains. We were talking about short and long-term capital gains. Typically in real estate, long-term capital gains, that line right where you cross and it's long-term is a year.
Yeah, right. Same for stocks. Yeah.
Same for stocks. Anyway, same for stocks. So short-term is treated as ordinary income most of the time, right?
Yes.
Which is the highest tax. Long-term is taxed at what?
That's the max 20%.
20%, right? Okay. So just right there, that's an automatic advantage. Just right there, if you can make money through real estate appreciation, right? Buying something, it appreciates in value, you sell it for something higher, you're subject to a long-term capital gains tax. It's only 20%. Instead of up to 37, not including state, it's an immediate almost 15% savings right there just by saying, hey, if you make your money in real estate and you hold that real estate for at least a year, we'll give you a 15% tax break. I want to make sure everyone's appreciating and understanding that.
Yeah, and most all of our deals are going to be more than 1 year, right?
And I mean, not all the development
Not
deals we're
always.
doing. It depends. So right now, some of our investments, they are going to produce some short-term capital gains. Those are some of the opportunities that we have. And so we're taking advantage of those. But I guess if we make investors 25% on their money, and they have to pay a little bit of tax on that, that's just the cost of doing business. We're taking the returns where we can get them. But most of our passive cash flow investments will all be long-term capital gains, and so they'll take advantage of the lower rates. Right. All right. What else, Brian?
Okay. I would say we should discuss 401ks and IRAs because most people are familiar with those, and a lot of people are investing in those.
So I'll talk about Roth IRA and 401k, and then you talk about just a normal IRA because I think you have one of those. Mm-hmm. I don't have those. All my money is in Roth and 401k. Yeah. Go ahead.
Traditionally, when you roll over a 401k, it doesn't have to go into a regular IRA.
It goes into a self-directed IRA, but it's still under the umbrella of a 401k and treated as if it's in a 401k. Where what's different is if you, like, let's say I just have $10,000 and I go on a mutual fund site and I just buy stocks. Well, that's just a retirement account, or that's just a tax.
That's just a brokerage.
That's
account.
just a brokerage account.
Yeah.
So 401k, they take money out of your check without taxing you any money on that, and then it goes in tax free. That's great because if you're a high earner, let's say you have $100, you would have 70 to put in your pocket and invest. Instead, you invest 100, and that 100 gets to grow tax free. So every year you don't pay tax on it as it grows, and you started with a 30% increase in the original amount.
So first dumb question, just so nobody feels bad. Why is that an advantage, right? You're delaying the tax, but you're paying the tax later, right? It's an advantage because you're not paying the tax, and that's allowed to go cumulatively compound on itself for 30, 40, 50 years in the market before you pay the tax, and the tax is relatively the same.
Well, most of the time you're going to be taking these things out when you're 60, 70, 80 years old,
right?
And you have no really ordinary income, and so your tax rate would be lower than during your income generating years.
So it's lower, and it gets to go into the market and compound on itself.
Yeah, let's say you're making, and this, I know this is not everybody, okay, I'm just picking an example. You're a high income earner and you're making $300,000 a year, and I don't know what your exact tax bill would be, but let's say it's going to be 30%, okay? So then fast forward, you invest in your 401k, it grows, compounds, tax-free, you have $3 million. Well, now you retire and you don't have that $300,000 income anymore, okay? And you say, okay, my house is paid off, my cars are paid off, I'm just going to start drawing $50,000 a year. Mm-hmm. Well, what's great about that is that you're going to pay a way lower rate on that $50,000 than you would have paid when the money went in, and because the balance has grown to such a huge amount, that the interest you're earning on that amount is probably more than you want to take. So it allows you to take an income in perpetuity without ever decreasing the balance. Because if you have, let's say you have $3 million in there and you're making 10% on that, you're making $300,000 a year. Mm-hmm. And so if you're pulling out $50,000, $100,000 a year, paying a lower tax rate, you can do that indefinitely, and your balance will still grow.
So the maximum 401k contribution limit for 2023 is $22,500 for an individual, and $30,000 if you're 50 or older.
Right.
Yeah. So you can really get after it in your later years to catch up.
And again, the other reason we encourage this is to get the free employer match, right?
Yeah.
Do it up to the free employer match, then maybe consider something else. But that free employer match, I mean, it's free money.
Yeah.
Now, let's say that you don't make a lot of money. You're not a big time earner. Well, so then your tax bill's lower. So then a good option for you might be a Roth IRA. Yep. Because let's say you're in a 15% tax bracket for whatever your situation is. You have a lot of deductible kids. You've got some deductions here or there. Okay, you want to do a Roth because then you're only paying 15%, but it grows tax free. Right. So you pay the tax up front, but it grows tax free, and you take it out tax free. And so that way, it can grow to 1 million, 2 million, 3 million. Then when you start taking the money out, you can take as much as you want out, and you don't pay any tax on that.
Yeah.
So that's also a great benefit.
Yeah. Also, if you die and leave it to your children, they can pull it out tax free as well.
Yeah. So that's a great option. Now the limits on that, it's a lot lower. It may be $6,000 per person, $12,000 a couple or something. It's lower than the amount you can put in a 401k, but still can be valuable based on your situation.
No, you can do a Roth 401k. You can do the $22,500 in a Roth 401k
if your employer offers it.
Yeah. Yes.
And the Roth IRAs, it excludes high income earners. There's an annual compensation cap. Like once you pass a certain amount, you can't contribute to a Roth.
Well, I never hit that. I never hit that amount.
All right. So,
Okay.
Brian, what about a traditional brokerage account or just a stock account that you're holding? Talk about some of the taxes you might deal with that.
Okay, so you're talking about just a brokerage account, not a retirement account, right?
Right.
Okay, so you're going to put some money in. You're going to buy stocks or mutual funds, and it's back to short-term and long-term capital gains. If you buy and sell stocks and you sell it less than a year before you sold it, then you're going to pay short-term capital gains. If you wait a year over or more than a year before you bought it until you sell it, then it's a long-term capital gain. And then the stock is also going to pay, well, not every stock, but a lot of stocks pay a dividend, right? And a dividend is considered like a long-term capital gain or a capital gain.
Okay. And so the takeaway for that is really just focused on the long-term versus short-term. So you're going to want to decide your strategy. Either you're going to trade stocks and deal with the short-term capital gain, or you're going to want to make sure that when you buy a stock that unless you have a really good reason, you're not going to want to sell that stock or the mutual fund before a year, because all that's going to do is add on to your ordinary income. And if you're already at 35% in ordinary income tax, that's what that's going to be if you sell before a year.
That's right.
Okay, next.
So now I think, the only other thing I might consider talking about is municipal bonds, and those are bonds that you can buy tax free. So you might only get 8% on your municipal bond, but if you're getting it tax free, then that can be that 8% increase.
Could be the equivalent of 11 or something.
Yeah, right.
Are there really 8% bonds?
I don't know if there's any 8% out there. I haven't bought a bond in a long time.
We're getting close to where
we might.
No, I guess
they might be.
Now they have to raise it to be competitive with
right.
savings accounts. They have to beat a savings account, otherwise no one's going to buy the bond that the city issues.
It's probably not at 8, but it's probably not. It might be 4 or 5.
For most of my lifetime, with interest rates low, they've been like 3, 4, 5%, and so it's never been that attractive. But in a really high interest periods, it could make some sense.
Yeah, right. So that's all the ones I have that a lot of people invest in. So how might we compare that to commercial real estate? Braden already made the point previously, but what else? How would we compare that to investing in real estate?
Well, we left off two of the biggest ones, right? Depreciation and depreciation recapture. Depreciation recapture is at 25%, I believe, right? And you're allowed to depreciate the property today, so you get the free write-off when you're not incurring the expense. And I'll give you an example. We bought, $5-6 million property in May of last year, and that property lost almost $2 million last year. It wasn't an incurred expense, right? It was depreciation. When we pay that back, it's 25%, which we established, maximum ordinary income is 37. So 25 is looking pretty good for an expense you don't actually have to pay out and incur. That, and most people who are buying real estate are doing it with some sort of leverage component, and you're allowed to write off interest, right? So that's a massive component, and you can keep some of this stuff. So you can keep a property 5, 7, 10 years. You're paying down that principal. That mortgage balance is lower. Your property's appreciating through rental revenue increases. Lease renewals. You're getting higher rent amounts. So you refinance that property eventually, and then that's not taxable, right? Because that's a loan, not a sale or a taxable event.
Right. And
you can continue writing off interest. A lot of people on their personal home, I think you can only write off interest up to $750,000.
Yeah.
But not in commercial real estate. You can get the biggest commercial real estate loan and just write off all that interest.
So I'm gonna give some people some information to go research, because this show we're up to 20-25 minutes, and so we're gonna wrap it up. But I want to encourage you guys with this fact: can commercial real estate, can you make millions of dollars on one property in commercial real estate and pay zero tax on it? Braden, Brian. I'm talking about income tax, not real estate tax.
Well, are you talking about?
I think you're eventually going to get hit with the small tax from operating rental revenue. It's going to be minuscule because, like I said, you're getting depreciation, which may eventually run out, but you're always getting to write off the interest component as long as you keep levering up. But there's a way to get out of most of the capital gains tax.
Yeah, what completely. I would say is the answer is yes. You guys are taking it a step further. You can buy commercial real estate and you can make money even up to millions of dollars and pay zero tax on that for the foreseeable future.
Yeah.
There will be a day where you'll have to make some tough decisions that you may start having to pay taxes. But you can go years with making money and making even millions of dollars and paying zero tax. And it could be a decade, it could be 2 decades before that catches up. I don't know of any other investment that provides that kind of money-making opportunity where you can legally pay no tax. And so if you don't know how that works, then that's what we're talking about when I tell you to get some books, get on the internet, get on YouTube, how to pay zero taxes while owning commercial real estate or whatever you want the search to be. Mm-hmm. But we're just saying we can't get into all the details, and we are not professionals in this area, so we wouldn't try to tell you all the nuances of that. But that's what we're talking about. No other investment provides that, and that's why real estate is one of the favorite investments for the rich, is because they can curb or even eliminate their largest expense, which is taxes, all while making a ton of money.
They say 90% of millionaires are made through real estate.
Yeah, I've heard that.
So
they also say 100% of billionaires are made through private equity.
Well, then we need to get into that, I guess. All right, guys, I hope that was informative. It was just a short sample of some tax discussions. And if you have questions, hit us up. We'll do the research for you if you'll tell us what questions you have. And until next time, how to invest in commercial real estate. Thank you guys for subscribing to the podcast and listening. We appreciate it.
Thanks.